In this video, I'll talk about the difference between analyzing a stock and analyzing and investing in a small private business. So if you're new to this channel, my name is Moran Pober. I'm the founder and CEO of Acquisitions.com. In the last 3 years, we were involved in 100 plus acquisitions of $1 million companies. We are right now the largest M&A community. We got tons of roll-up M&A entrepreneurs and investors. And right now we're looking to invest in roll-up and M&A entrepreneurs with our fund. The biggest thing to start and understand is that when you buy a stock, basically a equity in a public company, you basically buy a percentage of a business. And it's very similar to the idea of buying a private business, just that when it's a public business, it's listed, they sold shares to the public. When you buy a public business, a lot of people obviously can't buy 100% of the business. When you buy a private business, a lot of the acquisitions are being done for majority. Again, it really depends on the type of buyer you are. I don't want to overwhelm you with things too much. When you buy private businesses, a lot of the acquisitions are for 100% of the business or majority. You won't see a lot of people, private individuals, buy like 5% of a business. And I'll go into the details on why in a second. The biggest tip I would give you is remember, making money is hard, but even harder is keeping money and investing it right. So the biggest thing and challenge I see is that people, especially in the public markets, they just invest in random companies because of hypes, but they don't know the fundamentals. They don't know what's working, what's not. They don't know what is a good business and what not. They just throw money out there because they saw a cool video or an article on that. Another cool thing I would tell you is I think investing in private businesses versus investing in stocks is almost like, imagine if you had the option to invest in LeBron James before he became famous, before he got to high school even, versus investing in LeBron James after winning a few championships. Think about it this way. When you're investing in LeBron when he's like 16, then your upside can be much better, right? Obviously, you're taking more risk, but your upside could be insane. You can make 10, 100,000x on your money. And that's what you see when you're investing in private businesses. So investing in LeBron Young is like investing in private businesses. Investing in LeBron after a few championships, then, your upside can only be so much. So it's perhaps more stable, but are you really going to see 100x, 1000x? Very difficult. So here are the few things to look at when you're looking at businesses, private or public. I'll talk about the differences. But the first one is revenue growth. So revenue growth, obviously, it's nice to see, right? You always want to see revenue growth if you want. And of course, if you see a company that grows fast, then you can probably pay them more, right? So for example, if 1 year a company did 10, the next year a company did 12, and then year after they did 14, right? It goes up. Guess what? They'll ask more, right? So you need to ask yourself, look at the numbers. Are they going up or not? Is it consistent? Or is it like 1 year 10, 1 year 8, 1 year 12, right? That's another thing to look at. Ask yourself why there's no consistency. And also ask yourself, okay, now when we're thinking about public versus private, ask yourself, do you like when the numbers are going up or potentially not consistent or potentially even going down? Like what if you would see company doing 10, 9, and 8? Would you be happy seeing that? Depends, right? Are you looking to do a turnaround deal? Are you looking to invest in growth company? Do you have any control or say in the business to change things? So revenue growth is the first thing you want to think about. Second thing is profit growth, right? So does profit goes up or goes down? Definitely want to look at it. I don't care if it's a private or public company. Again, is it consistent? And if the business is failing, the profits is going down, it's not looking good. If the company profits goes up while revenue goes down, that's another thing you need to look at, and vice versa, right? Of course, if the profit goes up while the revenue goes down, it means that there's something good going on in there. It means that the operation is better, something is working well. If the profits goes up, if the revenue is staying the same. And of course, you can look at margins as well, but I want to keep things really simple right now. Next thing we can talk about is free cash flow. Free cash flow is basically the money that the business can then use to pay dividends, to pay debt, to grow the business, to do acquisitions. So can I see consistent growth in free cash flow, right? From the core business. I want to see cash flow from the core business, from the actual operations of the business. Otherwise, again, if we have problems with cash flow, then it's a turnaround deal. And I need to ask myself, is that a business I want to be involved in? Do I have any say? Can I take control? Can I be responsible to make any difference? Can I trust my skills to make any difference? And then do I want to be involved or not? Then we can talk about, especially if you guys investing in the public markets, we call it PE ratios or PE ratio, right? PE ratio is basically price divided by earnings. So what is it for you? And obviously the numbers are going to be different in a public company versus a public versus private. And in the public, anything above 20, like for me, I'm like, okay, do I want to be involved at all? It's probably usually very fast growing company. Sometimes just because of there's some kind of a hype, then they're getting huge multiples. Huge PE ratio. And obviously, if there's hype, especially in the public markets, then everyone wants it. You can also see it in private markets sometimes. Like you see companies like Clubhouse that got valuation of a few $1 billion and they never made $1. Never. Cool. So they had databases and future potential and great VCs, but so what? Right? Amazon got like 120x last time I checked PE ratio. I mean, you can buy companies at like 2-3 times. Right? Obviously, you're not buying Amazon, but you can buy really good businesses, So you need to ask yourself, what kind of returns can you see here versus here? Of course, you're not doing the same amount of work in Amazon versus in private business, but sometimes so what? Sometimes it's, what else you got to do? Sometimes doing the work is good. It's fun. So that's another thing I'm looking at. What else? I want to look at total current assets, and I want to make sure that it's bigger than total current liabilities. That's something you can check in the balance sheet. So I want to see that there's enough money to pay current liabilities fast. For example, if you owe someone $15,000, but you only have $10,000 in your bank account, guess what? You're in trouble, right? So all those things you slowly want to go through and ask yourself, can I put a check mark, right? Can I put a check mark? And if it's not a check mark, okay, what kind of deep dive due diligence I need to continue to do to see if it's a deal worth my time and my money? Next one I like to think about is profit margins. What do you think is a good profit margin? I mean, anything greater than a 10 is something that worth potentially looking at. I don't know if anyone looked at like a supermarket margin. It's insane. It's so low. I don't even know how they operate those businesses, seriously. When you have softwares, for example, technology businesses, you see much higher margins. Why? Because there's not a lot of like expenses per sale, because you can replicate things really easily once you make things once, right? Versus other businesses. There's a lot of expenses with every new product you sell. So profit margin, definitely something I want to pay attention to. Next one is operator or CEO. Let's say CEO, right? So who's the CEO? Do you like him? Do you trust him? Does he have some background, credibility? Is he committed to the business or is he committed to his income? Is he incentivized to grow the business or is he incentivized to just do as least as possible and just still get paid? Like if you look at Elon Musk, I think one of the things that people really admire in him is that if you Google Elon Musk's compensation plan, the reason he became one of the richest people in the world is because he had a compensation plan that earned him, I think like a 1%, I don't remember the exact details, but about 1% in Tesla stock for every $1 billion in market values created. That's how you become the richest person in the world. And there's even a video somewhere of someone laughing at him, like, who would do that? What are the chances that Tesla will get there? Like, no one believed in that. He did, and look what it got him, right? But what I'm saying is that his compensation was in direct proportion to the performance of the company. So if you believe in Elon Musk, if you believed in him 10 years ago, then guess what? You probably did really well. But if you would see other CEO that get most of his compensation from, just a flat rate income, then guess what? He's not going to be as incentivized and motivated to grow the business. So the CEO play a major role as well. What about management in general, right? So can call it management. Let's call it management for now. Management, governance, like who's in control in making decisions? Is it one of the shareholders? Is it the CEO? Is it someone else? Is it the board? Is it a combination? And again, here the difference in public and private businesses are very different, right? In public companies, unless you're playing a big part of that, you obviously can say nothing. In private, you have more of a say, especially if you're a key player in there, right? So this is key with the CEO as well. How much control he has. And that's why with our fund this year, we're going to look at thousands of deals because we have access to so many people in our network. We can look at so many deals before making the decision on one. So just like access to deals will give you more options. Another thing I want to look at is amazing products, right? When you look at a company like Apple, why do you think they're so good? Their products are just freaking amazing. I can't imagine myself having any technology product that isn't Apple at this point. It's just ridiculous, right? I don't even think twice. Why? Because I'm so used to everything that they're doing. When I'm trying to touch like Windows stuff, it's like I'm feeling weird, right? So amazing product. Like their earpods that they just created, they did more revenues than most businesses ever will, right? They have great distribution. They brought another great product and they're just killing it. And then I will add another thing that I really would love to see is recurring revenue. Why recurring revenue? Because in the end of the day, I don't care what business you are, it's easier to get a client back to you versus to find a new client from scratch. So when you have a business that's bringing clients again, back again and again and again with some kind of a recurring model, then it's brilliant. Or if you can be someone like Apple, they're just constantly producing, creating new innovating products. And obviously they build such a brand, they have such a distribution that as soon as they launch a new good product, they can promote it to all of their existing database. So that's definitely something to pay attention to, right? What distribution channels they have and what products they have. So those are kind of like the main key things that I want to look at. Of course, you always want to think about what are you paying, who's in control, the ratios, access to liquidity, right? Obviously, in a private business, you're not going to have as much of a liquidity, but your upside can be much better. You can have more control. You can have a say in the business. You can really know what's going on versus in a public company, you don't know. Every few years, you have a company like Enron, or there was another story in Germany 1 or 2 years ago. Multi-billion-dollar company just collapsed, had to bankrupt because they had some messy things going on there internally, right? And you don't know that usually if you're just a passive investor in those companies. So when you're looking at deals, public or private, you want to start to think about those things. And you want to start to think, okay, do you have some kind of a red flags? Do you have some red flags or do you have a check mark? Otherwise, if you're not looking at those things, you're just investing in random stuff just because you thought it's cool. And don't get me wrong, like there were people who made some money last year, but in the end of the day, you need to remember that you need to understand and look at the whole picture. And investing is an art, it's not a science, right? So you need to keep that in mind as well. Of course, the price, how much you need to pay for it versus the red flags, and are you willing to take those risks? And everyone here is in a different situation. Of course, you can also use leverage or not, sign personal guarantees or not. So in private business, let's just kind of like go back. In small businesses, private businesses, when they're still small, you have much more chances to get a say in the business and have an impact on the business and product. And you can start early, so you can potentially see 100x, 1000x in businesses if you do roll-ups or have a really fast-growing company. If you're investing in a company like Amazon already, which I think is one of the greatest businesses of our times, but you're already trading at 120x. So, I mean, to grow from here, like the business just got to be perfect. And for those of you who ran businesses before, it's not easy. Like the fact that those guys are still growing in my mind is like, it's insane. It's just like taking my hat off. They're brilliant, right? But how much more of an upside you have from here? I don't know. Like, are there still so many people who don't know about Amazon? So they need to really innovate and come up with something really unique to continue to grow at that pace that they're used to and get those valuations. Also, what about a recession? If we're going to hit some kind of a recession, some of those fast-growing companies in the public space can see drops of like 30, 50%. In the private market, you don't care about the price as much in the short term until you sell the business because you invest for cash flow for exit. So only when you sell, you can really know the full return on things. Same with public companies, but with public companies, just I don't care who you are, it's just stressful when you have access to see your stock price right away, all the time. You can't tell me that you don't look. If you have a lot of money in one of the public companies, you're looking, right? In a private company, that's one of the nice things. You can have a quiet mind because the money is there and you can just focus on growing the business, you or the team that you have. So also think to yourself, what's your risk appetite, right? Are you a person who is looking to invest to get 100 or 1000x, or are you fine with just like 10%, right? And of course, it can be a combination, it can be diversification. But you need to ask yourself, are you the kind of person that invests in people or in things with the idea of having 1000x, investing in LeBron James when he was 15? Or are you the kind of person who would invest in LeBron James after a few championships when you still have that, but the upside, the difference in jumps is not as big? And I think diversification is important, especially in the way the world is going on right now. So I don't care what you're investing in. I think it's important to have some kind of a diversification. At the same time, I also believe that wealth accumulation happens at concentration and diversification happens when you want to preserve your wealth. But also, again, it depends on your situation, where you're at and what you're trying to achieve. I think in order to preserve your wealth, diversification is the thing to do, 100%. And especially with the messy world we're living right now. I mean, crypto, real estate, stock markets. I think that not enough people know about the small private businesses space. And hopefully that's what will open to our investors club in the upcoming year. So we'll just be able to present deals to you, accredited investors only to begin with, to be able to expose yourself to that asset class. So yeah, if you enjoy that quick video, let me know.